Hey, it's Tom here and welcome back to the channel. So this is going to be the third and final part of the short little Alibaba series I've been doing on the channel. Thank you to everyone who's gone and watched the first and second part in the series already. If you haven't, I definitely recommend going and checking that out before you watch this video. But thank you to everyone who's been following along so far. In the first of these three videos in the series, we talked about the delisting risk with Alibaba. We also covered the VIE/ADR structure. In the second video, we talked about fines, antitrust fines that Alibaba have experienced. Also a pledge that Tencent made, tax rates and education stocks are crashing in these past few weeks. And in this final episode, I'm going to talk about two topics, namely share buybacks and an intrinsic value assessment for Alibaba. So if you enjoyed the video, please hit like and also consider subscribing if you haven't already. Like I mentioned in the past couple of videos, I'm going to be giving away a copy of Poor Charlie's Almanac back here at 30,000 subscribers. So be sure to follow along for when we reach that milestone. Okay, so intrinsic value and share buyback. So I'm actually going to start out with intrinsic value. This is typically the last thing I talk about when I analyze a company, but since we're talking about share buybacks, we can only really make a call on whether we think share buybacks are an intelligent decision or not based on what the intrinsic value of the company is based on the current market price. So I think it makes sense to start out with assessing the intrinsic value of a company. And if you haven't seen them before, I do have several videos on the channel about how I go about calculating intrinsic value. But a quick recap on that topic for those of you who maybe haven't seen those intrinsic value videos before. Basically, when we assess the intrinsic value of a business, we're trying to project out the future cash flows that we think that particular company may produce. We're then looking to basically discount those cash flows back to figure out an appropriate price to pay for those future cash flows today, as we are sort of buying stock and buying shares in the company. And we're basically trying to figure out what we fundamentally think the business is worth. If a very well-informed buyer and seller in a private business deal were to try and put some sort of value on this company, this is kind of the way that they would often approach that process. So if we can buy into the business at a substantial discount to intrinsic value, that provides a margin of safety in our investment. So in other words, we're able to buy shares in the business, buy ownership in the business for less than we think it's worth. And that provides some protection should the business results not be as good as we'd initially hoped, and also provides some extra potential upside for us should the business go on to produce the cash flows that we think it will. Okay, so in order to start projecting out some of these future cash flows for a business like Alibaba, we're going to need a couple of key pieces of information. The first one is basically the current free cash flow for the business. How much cash did Alibaba generate in their last year or maybe in the last couple of years, so that we can get an idea of what current cash flows kind of look like. And then we also need to figure out how fast we think Alibaba can grow those cash flows out into the future. So in terms of current cash flows, I'll put up some screenshots here from Alibaba's last 2 years of annual reports. In 2020, in US dollar terms, Alibaba produced $18.489 billion US dollars, and in 2021 they produced $26.353 billion US dollars of free cash flow. And when I say 2020 and 2021, Alibaba's financial year is from April to March. So the 2021 free cash flow of about 26.4 billion is actually from the period 1st April 2020 through to the 31st of March 2021. And for whatever reason, on some of the websites I typically use to get free cash flow data, there's actually a wide range of numbers being reported for Alibaba in 2020 and 2021. So that's the reason I've just gone direct to the source and looked in the actual published Alibaba annual reports to get a good feel for what that number really is. Like I say, in 2021, those annual reports show about 26 billion US dollars. On some websites, it was reported actually as high as 35 billion US dollars. So I'm not quite sure what was going on there, whether that's pulling in the first quarter of the 2022 financial year or quite what's happening there, but we'll be conservative and we'll stick with what's actually in the annual reports with the 26.35 billion number. Now the next bit of the puzzle that we need to figure out is how fast do we think Alibaba can grow out into the future. And luckily for me, I actually did some work and did a video on this just a few weeks ago in a video called How Large Can Alibaba Grow? And that video really focused specifically on the e-commerce business for Alibaba, and I did that for a very specific reason. So Alibaba is quite a complex kind of array of businesses at this point. It's got their core e-commerce business, which is a little slower growing than some of their other big business segments now, but it still accounts for the vast majority of their revenue. I think it's still around 70 or 80% of their revenue. I'll put those exact numbers up on the screen here. And Alibaba have also come out and published some targets that they want to hit in terms of growth in their e-commerce business. So in a 2020 Investor Day, they specifically said that they want to take their 1 billion annual active customers that they had at the time in 2020 through to 2 billion annual active customers by 2036. So if you run some numbers on that, that's about a 4.5% compounded annual growth rate. Now, in that video, I also talked about some of the growth in annual spend that Alibaba customers typically experience as well. And from that video and from that research, I basically came to the conclusion that I think personally that Alibaba can continue to grow their e-commerce business at about 14% per year compounded. The other thing to keep in mind with Alibaba specifically is many of their other fast-growing businesses are not actually profitable yet. So the big one that you'll hear a lot of people talk about is the Alibaba Cloud business. That is kind of just getting to break even within the last year or so. So that is really not contributing anything meaningful to current free cash flows. Alibaba also has this big 1/3 ownership stake in Ant Financial, which owns Alipay among a range of financial service focused businesses. And Ant Group was actually initially intended to IPO earlier this year at valuations potentially as high as $300 billion. So if Alibaba owns a third of that $300 billion, that stake is worth about $100 billion. And I've seen really wide-ranging valuations on Ant Financial, anything from as low as $100 billion to as high as about $335 billion. But we really don't know for sure what that stake is worth. So if we combine the fact that Alibaba Cloud is not yet profitable, and we also really don't know what the Ant Group is worth, and Alibaba's 1/3 stake in the Ant Group is worth, for today's purposes, I'm really just going to focus on the core e-commerce business of Alibaba. Okay, so these are the results that I start to get when I run some of these numbers. So I have a couple of different sort of scenarios here. The first one is if I grow that current free cash flow out at the 14% per year that I mentioned earlier. If anyone cares about sort of the nitty-gritty details of discounted cash flows, you'll see some of my other assumptions on the screen here, but I'm using 10% discount rate and I'm using a 15 times free cash flow sort of terminal multiple as well, just in case you're wondering those details. So the first number that I get if I grow cash flows at 14% per year, discount those back at 10%, use a 15 times free cash flow terminal value like I said, I get a current intrinsic value for Alibaba's e-commerce business of about 780 billion US dollars. Now, Alibaba currently has about 2.7 ADRs or shares outstanding, which means the intrinsic value on a sort of per share or per ADR basis is about $287. There's a bit of sort of false precision you get from spreadsheets, so don't read too much into the individual dollar kind of numbers coming out here, but about $287 is what we come out with, or a 40% margin of safety at current prices, which is current price as I'm recording this video is $172 per ADR and about a 465 billion market cap. And the second scenario that I have here is Alibaba only growing at about 10% per year. If it only achieves 10% per year growth, bearing in mind it's grown at like north of 50% per year in the past, but they're getting to such a large scale now that they're almost certain to slow down. So if they only grow at 10% per year, I still get about a $600 billion intrinsic value, about $220 per share, or a 22% margin of safety at current prices. So there's some really interesting numbers now starting to come out, and please don't take this as a stock tip or a recommendation to buy or sell Alibaba or anything like that. This is my own research, my own work, and my own kind of numbers that I'm just kind of sharing with you here. So some really interesting numbers starting to come out. It's starting to become more and more obvious to me over time why potentially there's a long list of super investors starting to buy into Alibaba, because with those numbers that I showed, it is at a significant margin of safety if it can continue to grow at strong rates out into the future. And like I said before, there's a few kind of key things to keep in mind. So that really doesn't give any value to the very fast growth of the Alibaba Cloud business. It doesn't give any value to the stake in Ant Financial, and it also doesn't include their quite significant net cash position as well. So Alibaba currently have about $40 billion in net cash, or in other words, their cash exceeds their debt by about 40 billion US dollars, which is not an insignificant number either. Okay, so let's just talk a little bit about share buybacks. So firstly, I'll just read a sort of statement that came out in Alibaba's most recent earnings report. They said on increasing share repurchases. Since April 1st, 2021, and through the publication of this results announcement, we repurchased approximately 18.1 million of our ADS, the equivalent of approximately 144.5 million of our ordinary shares, for approximately 3.68 billion US dollars under our share repurchase program. In addition, on August 2nd, 2021, our board of directors authorized the company to upsize our company's share repurchase program from 10 billion US dollars to 15 billion US dollars. The share repurchase program will be effective through the end of 2022. So again, a very interesting update for long-term sort of ongoing shareholders of Alibaba. They're currently producing free cash flow of about $26 billion a year, and they intend to spend about 15 billion US dollars between now and the end of 2022 on share buybacks. I think share buybacks are a fairly straightforward but often very misunderstood kind of subject. And I quite like to put it in sort of Warren Buffett's analogy terms. So Warren Buffett often gives this example when talking about share repurchases and the value of those repurchases as if you were in sort of a private business arrangement. So if you owned, let's just say, a real estate business for simplicity with yourself and maybe 4 or 5 of your friends, and together you owned, let's say, $5 million in real estate. You own a range of rental properties, and market rates suggest that those rental properties are worth about $5 million. Now, if one of your particular partners wants to sell their shares and they say, I can't really be bothered, messing around and negotiating with all you guys for too long on getting out of this partnership. I kind of just want to go. And I'm happy to sell you my proportional ownership, my shares, at a valuation of only $4 million. So I'll give you guys a bit of a discount on the actual value of these assets just so you can buy me out quickly and I can go off and do other things. Now, if you're an ongoing partner in this, real estate partnership, being able to buy assets worth $5 million at a $4 million valuation is a really good thing for your financial health. If you can buy out business partners that are willing sellers and they're happy to go at a discount to the actual value of those assets, that can create a lot of extra wealth for ongoing shareholders. And when it comes to share repurchases in public companies, the equation is absolutely no different. There's a lot of share buybacks that kind of go on for nefarious reasons, people trying to pump up the stock in order to exercise stock options, as very high-paid, high-power CEOs and all that kind of stuff. And that's not really what you want to see as a minority shareholder in one of these businesses. But what you really do want to see is the businesses buying back shares opportunistically when the price makes sense. Share buybacks can obviously be done at any time, but if you pay a really high price for your shares, well above intrinsic value, they can destroy value for shareholders. If that partner in this $5 million real estate partnership wanted to sell their assets at $10 million, and that's the only way you're going to get rid of them, that's not going to create a lot of value for shareholders. But if you can, buy it at low prices below the intrinsic value, that can certainly create a lot of wealth for ongoing shareholders. So if Alibaba can continue to grow at strong rates and they are truly trading below their intrinsic value based off these projections, then these share buybacks are a great thing for long-term holders of the stock. Okay, so that's it from me for this video and for this 3-part short kind of Alibaba series that we've done this week. I do hope you enjoyed that full series. Definitely let me know your thoughts on that down in the comments below. For me on the Alibaba front, I think I've shared about all the thoughts that I really have on the topic, so it's probably time for me to go back to some other topics on the channel. As much as I love all the Alibaba channels that are out there on YouTube, I would prefer not to turn into a pure Alibaba focused channel over the long term. So time to get back to some other topics, I think. But like I say, I really do hope you enjoyed the series. Like I also said at the start of the video, and like I've been saying throughout this series, I'm also giving away a copy of Poor Charlie's Almanac at 30,000 subscribers. So definitely subscribe to the channel if you would like to see future content as well. But that's it from me for this one, and I will see you in the next video. Cheers.